Well, I'm going to the city and I'm gonna do a silly show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week, and hopefully lots of great ideas and opportunities for you throughout the show. Well, here we are after a 13% gain in the best quarter since 2002. The stock market was in a relative standoff this week. Mostly there was some wide swings that didn't have follow-through. The yield curve was really what was in focus this week as the bonds soared to the upside, with at one point in a near panic overnight, the 10-year yields falling to 2.36%. That yield curve focus, well, there's a reason to watch it, as the 3-month to 10-year is inverted, and at that moment of panic overnight fell to about 10 or 11 basis points inverted, and now sits about 5 basis points inverted. Now, this inversion has forecast the last 7 recessions, and now what's interesting is that it's happening at the lowest rate ever. That is an incredible situation, and I recently did a video regarding that where I compare those yields, and you're going to find that fascinating if you go in and watch this. Still, with this inversion going on, analysts are debating whether or not it's the same this time, and many of them who love to be bulls say, well, it is different. Well, I think it is different, and I think it's different in a far worse way, as we have only a 2.25% Fed fund rate, and we have an inversion going on. Well, that shows immense weakness that's out there, and that could mean that things will be much worse than we've seen in past recessions. That's just speculation by me, but when you see that this inversion happens at such a low interest rates, you know, actually, it is different this time. And it is much weaker. Well, the Mueller report finally came out, and the president is partying over the results, of which they have no collusion with Russia. And, well, the Democrats, they won't let go. And the news in the background is really fascinating to watch regarding that. But there was no market reaction at all to that. A little blip I'll show you when that news came out. And there's plenty to be focusing on besides that, like the consumer confidence plunging, and home sales plunging, and continuing to be worse month after month, and the GDP now lowered for Q4, and world economy is just plain out slow. So that tiny little reaction that we saw when the news came out about the Mueller report, that might be foreshadowing what we're going to see when the trade news comes out. And there is, you know, little pieces of news that are coming out still that are bullish. You know, they're saying that things are progressing, and there was talks again this week, and Mnuchin comes out and he gives some favorable comments, and that lifts the market here on Friday. But we may, you know, we've celebrated that so many times that we just may not get much reaction if they do come up with a trade deal. Of course, if they don't and it blows up, well, you know what will happen. Well, the Fed's great experiment, which has us inverted in this yield curve at this low interest rate since 2008, does bring its benefits. And the IPO market is heating up, and that's because, well, there's plenty of money out there. Lyft comes out with a $24 billion value, opens up at $72, and then trades up into the high 80s as people are just scrambling. They have to buy this stock that lost $911 million in 2018, and there is very little possibility of this stock making money in the future, if ever. But they have to own it, and that's because the Fed makes money so cheap that there's nowhere to put it but in garbage stocks like Lyft. Now, Uber's going to come out, and they say that, well, there's a benchmark now set, and that would make Uber worth some 70-something billion dollars. Well, at least Uber has other products. Lyft is a one-product company. They haven't really developed anything else. And if you ask me, anecdotally, I don't think Lyft service is as good as Uber. So I tend to wait longer, and that's always an issue for people that want to get somewhere. And I don't think that this valuation makes any sense to me. And I think Lyft is an out-and-out sale. I wouldn't be surprised to see this stock over these next couple years cut in half or worse. But it does prove that earnings don't matter, and maybe that's why we have a Russell that was up as high as it was, because there's not many stocks there that make money either. Plainly, money is cheap and going to ridiculous places. The important for this week is the stock market's condition here, and we're going to look at that in the short-term view. That opportunity that we had for the market to rally, which I talked about last week, it's basically blowing it. We're getting a little bit here up on Friday, but overall, I'm going to show you how this is a relative strength weakness that we're seeing, which may be a sign. In fact, it could really have some significant meaning, as a window of opportunity for the market move up did not. And that is a pretty good sign that there may be something not so pretty coming in the near future. Talked about that big picture video that I did on the treasuries. I looked at yields and how they relate to the stock market, and you really should watch that. It's in our big picture analysis sector of our video library, of which there's 8 different segments of videos in there, and I think it's only 22-minute video, and it's just packed with information that I think you will find very interesting. The bottom line is that we're entering into a period where there is risk in the stock market, but it's only really for a couple months. So that could be that we're going to see some wide swings between now and the fall time. I think it's a big swing to the downside and a big swing again to the upside after that. That makes for maybe not such a bad year this year, but it does point to things that are could be big trouble going out to 2020. In fact, when I think that when this little rally that we're in right now fails, for the next couple of months, the market could hit some air pockets on the downside. Let's take a look at our 60-minute chart of the S&P 500, and we're going to see what moved the markets this week. Take a look here, and you can see a nice choppy week that we had here, and so much news actually that I actually had to make the little news items different colors in there. The market started out, you could see, moving to the downside. Asia fell hard on Monday, following all of that talk of the U.S. slowing down last week, so that brought a big decline overnight, as you can see. But then there was some upside blips, like right in here when that news came out on late Sunday night that Mueller's report showed no Trump collusion. You barely got a blip right over here, and then it started selling off again. So there was really concern about slowdown. When you come here on Tuesday morning, bonds softened a little bit. Now, when bonds soften and yields go up, the stock market has liked that recently, and that brought some bids in. But then the news came out early on Tuesday morning. Consumer confidence had its biggest drop since 2008, and housing starts slumped 8.7%. It tried to get up on Tuesday morning, but then Apple reversed to the downside after a judge ruled that they infringed on Qualcomm's patent, and some iPhones faced an import ban. That gave you this big move to the downside. You rallied overnight into the opening of the and through the opening of the European stocks. That's that when 10-year yields started to plunge right in here and the market started to move down. But Draghi came out super bullish, super dovish, and That's, I think, really scared the markets. Instead of being a positive, they're starting to look at this real weakness they're talking about as being a negative. That got the market moving to the downside. Stephen Moore came out, who's the Fed appointee, or soon to be, and he said that he thought that interest rates should be cut by 50 basis points right now. And I got to tell you, I think that is moronic. But if there's anything behind that, any substance at all, it's how weak he really believes things are. And here we are at only 2.25% Fed fund rate, and he wants a cut right now, another 50 basis points. How bad are things that they're not really telling us? Trade deficit narrowed sharply, which improved slightly against China, and then the semiconductors started to move down on a report that a German firm is slashing revenues on the China slowdown. And chip prices are very soft, and we got this big break here on Wednesday, and then it rebounded. So we had a lot of failed rallies and a lot of failed declines during this week. News came out a couple times about Turkey. Turkey is in just chaos right now, the lira collapsing, and they've been through several rounds of this, and that's really been putting pressure here, and you can see it's starting to affect the markets when that comes out. The Eurozone got a rally here on some news that they're talking about a tiered rate proposal. What this does is help their banks who are suffering immensely from negative interest rates. So they're going to try to make it tiered and give a little help to the banks, and that started to get a rally right in here. Oil fell on Donald Trump demanded that OPEC up their production, and he said that the world economy is fragile. So he wants lower cost of energy, which is essentially a reverse tax, to help the economies, and he should just stay the hell out of the markets. I'll tell you that. Third quarter GDP, the third estimate for the fourth quarter GDP moved it down to 2.2%, so that shows you the economy was already slowing back then. Pending home sales on Thursday come out, down 4.9%, the 14th straight decline, and markets didn't really like that news and fell off, but then rallied back again. Here's where Mnuchin came out here on Friday and said that, well, talks in Beijing, trade talks were productive, and you got this rally off of that, and then the market got very choppy. Here we are at midday here on Friday, and you can see the market is chopping around. It fell to all the S&Ps after being up some 14, 15 points to only up about 4. Then it rallied again, and it has been in this range right now, up about 11 points right now as we get into this half midday point right now in the market. So you can see a very choppy market this week, where rallies came and they couldn't hold, and sell-offs came and they couldn't hold. And overall, we've got some minor gains for the week in the stock market. All right, let's get into our best for the week right now as we look at Bed Bath & Beyond. This is a stock that all along for the last several years I have not liked. The patterns have been negative, and it has proven to be correct in that it was in bad shape. You can see in here as we look at cycle analysis how that played out. Each of these arcs, as you see in the bottom here, are called cycles. Cycles are measured from low to low, and you can see there are repeating patterns where there are similar lengths in each of these cycles in here as this trended to the downside. This one has our colored phasing in it, and when it's negative, you're going to see pretty small green zones and wider yellow and red zones, and when it's positive, you'll see long green zones. And these these arrows in here show you the negative configurations in these patterns. And now look what's happening, a positive configuration, 25% gain on the week, as activist investors have stepped in and they want to oust the board here and do what they can to increase the value of this stock. Now, based on what we're seeing in here, you can see the low really isn't due till out over here in May. So this rally looks premature to me. And I would say there's a buying opportunity coming somewhere out over here in late April or May. And I would not chase the stock up here, but still, it is basing and it is giving you this positive look. So I would say this stock is going to be investable in late April or May. 25% gain on the week, and the biggest one for the week. You just watched the opening to the askSlim Market Week show. To watch the full show, just become an askSlim free member. It includes my analysis on the best and worst stocks for the week and my short-term view in 5 major markets for the coming week. You're going to learn a ton about charting, technical analysis, cycle analysis, my unique way of looking at charts, and we show lots of ideas that may bring some great setups for you going forward. Here's what's in that great offer that I think you're just going to get a ton of benefit from. You're going to get the full Market Week show. You're going to get Market Week archives, the special videos from our premium library, sneak peeks to great new products coming up, and all kinds of things along the way that we're going to put in there that you're going to enjoy. All you have to do is become an askSlim free member, and there is no credit card necessary. Please do join and take advantage of that and watch the rest of the show.